So today's topic is income under head, profits and gains of business or profession. Basically, we are going to discuss that how a person doing business or working as a profession deals with his income for the income tax purposes. So in this topic, we will discuss various things like meaning of business and profession, various incomes chargeable under the head profits and gains of business or profession, income not taxable under the head profits and gains of business or profession, expenditures allowed as deduction, rent rates, taxes, repairs and insurance for building, repairs and insurance of machinery, plant and furniture, depreciation, additional depreciation, special deductions for assessee engaged in tea, coffee or rubber growing and manufacturing business, expenditure on primarily expenses and various other topics. So moving ahead, before starting, we should know about the meaning of business and profession as per the Income Tax Act 1961. So, business is defined under Section 2, subsection 13, which includes any trade, commerce, or manufacture. Also, any adventure or concern in the nature of trade, commerce, or manufacture. Generally, business means recurring economic activity, but for income tax purpose, on isolated activity may be termed as business depending upon facts and circumstances. Some elements shall be considered to judge a transaction as business transaction, like nature of commodity, intention of party, means the owner or the businessman, efforts applied in transaction, periodicity of transaction, nature of transaction, whether incidental to a business or not. Moving ahead, term profession is defined under section 2, subsection 36. Profession includes vocation. Profession requires purely intellectual skill or manual skill on the basis of some special learning and qualification gathered through past training or experience. Examples of profession: chartered accountant, doctor, lawyer, etc. Here terms vocation implies natural ability of a person to do some particular work like singing, dancing, etc. The vocation is different from the term hobby. Vocation must have the earning feature. It can be treated as an earning means by which a man passes his life. Unlike profession, vocation does not require a degree or special learning. So, the basic thing behind these terms, business and profession, is there should be profit motive or earning motive. If the motive of an activity is pleasure only, it shall not be treated as business activity. Moving ahead, now we will discuss about income chargeable under the head profit and gains of business or profession, defined under section 28 of Income Tax Act 1961. So basically, we are going to discuss about the various taxable incomes or portion of income which are to be added while calculating total income for the purpose of taxation. So, Section 28 enlists the incomes which are taxable under the head profits and gains of business or profession. So, first point is profit and gains of any business or profession defined under Section 28 Clause A. Any income from business or profession including income from speculative transaction shall be taxable under this head. Second, compensation to management agency defined under section 28 clause 2. Any compensation or other payment due to or received by any person managing the affairs of an Indian company in connection with termination or modification of terms and condition of his appointment. Next, income of trade or profession associations, income derived by a trade, professional, or similar association from rendering specific services to its members shall be taxable under this head. This is an exception to the general principle that a surplus of mutual association cannot be taxed. Next, export incentive. An export incentive in form of profit on sale of import license or duty entitlement passbook. Second, an export incentive in the form of cash assistance received or receivable by an exporter under a scheme of Government of India. Third, duty drawback received or receivable for export, that is duty drawback. So these 3 points constitute the part of export incentive. Next chargeable income is perquisites from business or profession. The value of any benefit or perquisite, whether convertible into money or not, arising from business or profession, shall be taxable under this head. For example, if an authorized dealer of a company receives a car from the company on achieving sales target, then the market value of such car shall be taxable under the head profit and gains of business or profession. Next chargeable income is remuneration to partner. Any interest, salary, bonus, commission, or remuneration received by a partner from the firm or limited liability partnership shall be taxable as business income in the hands of the partner to the extent allowed in hands of firm. Basically, we are discussing about the income portion that should be included while calculating the total income of a businessman or a profession. Moving ahead, next chargeable income is amount received or receivable for certain agreement. Means any sum whether received or receivable in cash or kind under an agreement for not carrying out any activity in relation to any business or profession. There are some exceptions to this rule. First exception is any sum received or receivable in cash or kind on account of transfer of the right to manufacture, produce, or process any article or thing which is chargeable under the head capital gains is not to be treated as amount received or receivable for certain agreement. Moving ahead, next chargeable income is keyman insurance policy. Any sum received under a keyman insurance policy, including bonus on such policy, is to be termed as or treated as chargeable income. As per section 10, subsection 10D, keyman insurance policy is a life insurance policy taken by a person on the life of another person who is or was an employee of the first mentioned person or in any manner whatsoever connected with the business of the first mentioned person. It includes such policy which has been assigned to a person at any time during the term of the policy with or without any consideration. Moving further, next chargeable income is recovery against certain capital assets covered under section 35 AD. So any type of recovery or sum received or receivable in cash or kind and on account of any capital asset other than land or goodwill or financial instrument being demolished, destroyed, discarded, or transferred will be treated as income generated and will be a part of chargeable income. If the whole of the expenditure on such capital asset has been allowed as a deduction under section 35D, it will be allowed. Moving ahead, now we will going to discuss some general points for better understanding of the terms or what is the process behind the calculation of business and profession income. So first point is chargeability. As per section 145 subsection 1, income chargeable under the head profit and gains of business or profession shall subject to provision of section 145 subsection is to be computed in accordance with the method of accounting regularly followed by the assessee. However, there are certain expenditures specified under section 43B which shall be deductible only on cash basis. Next, negative income. Income includes negative income, that is loss. So if a business or profession is having a loss, then it should be part of calculation. Next, notional profit. A person cannot do business with himself, hence notional profit is not taxable. Example, if proprietor withdraws goods costing 10,000 for personal use at an aggregate value of rupees 12,000, then the profit of 2,000 shall not be taxable. Next, anticipated profit or loss. Anticipated or potential profit or loss, which may or may not arise in future, are not considered for deriving taxable income. Moving further, next, legality of business. There is no difference between legal or illegal business from income tax point of view. Even income of illegal business shall be taxable. Next, compilation of income of all business or profession. If an assessee carries on several business or profession, then income from all business or profession shall be merged together. Next, business or profession must be carried on during the previous year. Income is chargeable under the head profit and gains of business or profession only if the business is carried out on by the assessee during the previous year. It is not necessary that the business should continue throughout the year or till the end of previous year. Next, exceptions. Income may be charged under head of business or profession even though the business is not carried on during the previous year. So we are discussing here some cases where income may be charged under head profit and gains of business or profession, even if the business is not carried on during the previous year. So we are having two columns. One column is section and another column is details. So here you can see that six sections are mentioned and their treatment or details are mentioning here. So section 176, applicability, where any business or profession is discontinued in any year and any sum received after the discontinuance will be part of profit or gain. So treatment for taxation purposes, the sum so received shall be deemed to be income of the recipient, as I said, and explained you to tax accordingly in the year of receipt. If such sum should have been included in the total income of the person who carried on the business, had such sum been received before such discount. Second section 41, recovery of any amount earlier allowed as deduction. Second, balancing charge in case of power sector unit. Next, sale of asset used for scientific research. Bad debt recovery which was earlier allowed as deduction. Amount withdrawn from a reserve created. So these are the exceptions which are to be charged as income under the head profit and gains of business or profession. Moving further, now we will discuss what are the income which are not taxable under the head profit and gains of business or profession. So some points are mentioned here. First is rent from house property. As we know that house property is taxable under section 22 under head income from house property, even though the assessee is engaged in the business of letting out properties on rent or such properties held as stock in trade. For your more information, however, where letting of house supporting the smooth running of the business, then such income shall be taxable under the head. So, income from house property will not be a part of business or profession income. Second, dividend on shares. It is also taxable in section 56 subsection 2 clause 1 under the head income from other sources. So it is not included in the income head of business and profession. Next, winning from lotteries, races, etc. These are also taxable under the head income from other sources. Even such income is derived through regular business activity. Some taxable under the head capital gain for the purpose of section 28 5A shall not be taxable under the head. For example, profit on sale of route permit shall not be taxable under the head profit and gains of business or profession. So these are some examples which are not treated as income under the head profit and gains of business and profession. Now we will discuss about expenditures allowed as deduction. As we all know that while doing business, various expenses have to be incurred by a businessman. These expenditures allowed as deductions for the purpose of income tax purpose calculation. So, first point is capital versus revenue expenditure. Capital expenditure are not allowed as deduction unless and until expressly allowed, whereas revenue expenditures are allowed as deduction until and unless expressly disallowed under the Income Tax Act. Second, expenditure on non-assessable business. Any expenditure of non-assessable nature is not allowed as deduction. For example, expenditure for earning agriculture income is not allowed as deduction from income of an assessable business. Next, continuing with the topic expenditure allowed as deduction. Expenditure must relate to the business of the assessee. If the expenditure is related to the business of the assessee, then it is allowed as deduction. Next, anticipated loss or expenditure. Subject to certain exceptions, no deductions are allowed for anticipated losses like provision for bad and doubtful debts. Next, notional expenditure. No one can earn income from himself or herself. So, for example, rent paid to a sole proprietor, salary to proprietor, interest on capital to proprietor, etc. are not income in hands of the proprietor. Moving ahead, now we will discuss about rent, rates, taxes, repairs and insurance for building under section 30. Rent rates, taxes, repairs, insurance for premises or business purpose used for shall be allowed under the section 32 and section 30. For understanding this, we have to understand some points like use of building. If the building is to be used for the business purpose or profession, then deduction shall be restricted to a fair portion of above expenditure which the assessing officer may determine under section 38 subsection notional rent. Rent paid to proprietor is disallowed, but rent paid by firm to its partner for using his premises is an allowed expenditure. So here two types of expenditures are mentioned. One paid by himself and paid for the premises. So we have to bifurcate these expenses for the income tax purposes. Next thing is current repair versus current capital repair. Only current repairs are allowed as deduction. Capital repairs are not allowed as deduction whether the assessee occupies the building as a tenant or as a landlord. Current repair, irrespective of the amount involved, means a repair incurred to preserve and maintain an existing asset and a repair which does not result in a new or fresh advantage. Next, municipal taxes. Rates and taxes, for example, land revenue, municipal tax, etc., are deductible on cash basis. So for this purpose, we have to read section 30 with section 43B. Now coming to next topic, repairs and insurance of machinery, plant and furniture, section 31. So basically we are going to discuss what type of expenses are allowed as deduction for the purpose of calculation of profit and gains from business and profession. So for understanding this, we have to understand these three terms. First, use of asset. The asset must be used for the purpose of business or profession. However, if the asset is not exclusively used for the purpose of business or profession, then deduction shall be restricted to a fair proportion or above expenditure which the assessing officer may determine. Second point, current repair versus capital repair. Only current repairs are allowed as deduction. Example, heavy expenditure incurred for replacement of a part of ship without creating any asset is deductible. Any expenditure on the replacement of petrol engine by a diesel engine on his vehicle is allowed under section 31. Next, repairs for furniture, plant or machinery. Only repairs and insurance of machinery, plant and furniture is covered under this section. Rent paid for such assets is deductible under section 37. So basically, we have to understand that which expense is allowed under which section, whether we have the permission to show it as expense, whether we have the permission to use the expenses as deduction. For this purpose, we are discussing this various expenditures till now. Now, moving ahead, next topic is depreciation. As we know that in business or profession, we have various assets. If we are purchasing these assets, then we are incurring capital expenditure. And when we are using these assets in our business, the value of these assets are depreciating. So basically, depreciation is defined under Section 32 of the Income Tax Act 1961. Two types of assets are defined. First is tangible asset like building, machinery, plant, and furniture. Second one is intangible assets like know-how, copyright, trademark, patent, license, franchisee, or any other business or commercial right of the similar nature acquired on or after 1st April 1998. There are certain conditions for claiming the depreciation which is defined by the Income Tax Department for the purpose of calculating or assessing the total income of the person or individual. So you are able to see that in the slide two columns are designed. First column is condition 1, second column is condition 2. So basically, if these conditions are fulfilling, then only depreciation allowed or provided while calculating the or assessing the income of the individual. Condition 1, asset must be owned by the assessee. Condition 2, asset must be used for the purpose of business or profession during the previous year. As you see, asset must be owned by the assessee has 5 points mentioned. First point is beneficial owner. It means assessee need not be a registered owner. Even a beneficial owner can claim depreciation. Second, co-owner. In case of joint ownership, depreciation is allowed on proportionate basis. Property acquired on hire purchase. In case of hire purchase, the buyer can claim depreciation even though he does not get legal title of the asset till he pays the last installment. Next, capital expenditure on a property by the lessee, where an assessee being lessee or a property incurs any capital expenditure by way of improvement, extension, super construction, etc., is entitled to depreciation of such capital expenditure. Also in section 30 and 53A of Transfer Property Act, professor or processor of immovable property under section 53A of Transfer of Property Act can claim depreciation even though he is not the registered owner of the property. So basically these points are helping you to understand the meaning of asset must be owned by the assessee. Now Condition 2. Asset must be used for the purpose of business or profession during the previous year. First explanation, passive use versus active use. Active use means actual use of the property for the purpose of business and profession, whereas passive use includes ready to use. It means if a property was not actually used for business or profession but was ready to use in the previous year, in such case, assessee can claim depreciation on such assets. Second point, partly used for business or profession. As per section 38, if an asset is partly used for business or profession, then proportionate depreciation shall be allowed. Next, house property let out to tenant for smooth running of the business. That is also eligible for depreciation. Moving further, we should know about the method of depreciation. With this help of chart, we can able to understand calculation of depreciation. As you see, WDV of the block at the beginning of the previous year means written down value of the block, or block here means the asset. Then we are adding into this assets falling within the block acquired during the previous year. Then we are going to less sale proceeds of assets. After deducting this, we get the written down value, and when we deduct depreciation from the written down value, then we get the opening written down value for first day of the next year. Moving further, when depreciation is not charged, there are two cases in which depreciation is not charged. First, when DE that is sale proceeds exceeds ABC, the excess shall be treated as short term capital gain. When XYZ value of block before depreciation is positive, but the block does not have any asset. In such case, such positive value shall be treated as short-term capital loss. Moving further, significance of date of purchase, effect of time on depreciation. Basically, we charge the depreciation because we use the assets for our business purposes, due to which there is a loss in the value of particular asset. So, time of purchase or date of purchase is to be calculated perfectly for the purpose of calculation of depreciation. Where an asset is acquired by the assessee during the previous year and is put to use in the same previous year for less than 180 days, the depreciation in respect of such asset is restricted to 50% of the normal depreciation. Except above, date of purchase has no relevance. Means date of purchase is relevance only in these two cases. Moving further, extract of depreciation rate. So this chart is mentioning the block name and the nature of asset and the percentage we charge on block for the purpose of depreciation. Building, you see there are three columns were written buildings, and in front of them rate of depreciation is mentioned as 5%, 10%, and 40%. So nature of asset plays an important role for deciding the depreciation percentage. First point, building 5% depreciation rate will be charged on the asset having the nature of residential building other than hotels and boarding. Non-residential building, godown, office, factory, etc., including hotels and boarding, depreciation rate is 10%. Temporary construction, 40%. In case of furniture, any furniture including electrical fittings, depreciation 10%. In case of plant and machinery, ocean going ships, vessels, speedboats will be charged by 20%. Motor car including lorries and buses used for hiring purposes will be charged 30%. Motor car other than using in business of running them on hire acquired and put to use between 23 August 2019 and 31st March 2020 will be charged by 30%. Moving further, plant and machinery is also having 45% depreciation, 40% depreciation. Motor buses, motor lorries, motor taxis having the percentage of 45%, computer including software, books owned by a professional includes 40%. Moving further, air or water pollution control equipment, depreciation rate 40%, oil wells 15%. In general, if nothing is mentioned regarding nature of plant and machinery, including motor car not used for hiring purpose, depreciation percentage will be 15%. If an intangible asset acquired after 31st March 98, then depreciation percentage will be 25%. Moving further, we will discuss now about additional depreciation. Section 32, subsection 1, clause 2a. Additional depreciation is taxable on all assessee engaged in the business of manufacture or production of any article or thing, or in the business of generation, transmission, or distribution of power. So basically, additional depreciation is applicable if assessee is engaged in such type of business. Some conditions to satisfy this applicability: assessee must be an industrial undertaking. Assessee required and installed after 31st March 2005 a new plant machinery other than the following, like ship and aircrafts, any plant machinery within or outside India, any other person before installation used by any other person, any plant or machinery in office premises or any residential accommodation or guest house, any office appliances or road transport vehicle, any plant or machinery which is allowed for 100% deduction, whether by way of depreciation or otherwise in the previous. For the taxation purposes, additional depreciation shall be available only on plant and machinery and not on the assets like furniture, building, etc. Rate of additional depreciation is 20% of actual cost of such plant or machinery, where if an asset is acquired and put to use for less than 180 days, then additional depreciation at the 10%, that is 50% of 20% of actual cost, shall be allowed in the previous year, and the deduction for the balance 10% shall be allowed in the immediately succeeding previous year. Moving further, special rate of additional depreciation in case of notified background area. Till now, we have discussed various depreciation rates on plant and machinery, on land and building, and various other assets. Now, some special rates of additional depreciation is also defined in the Act, like additional depreciation at the rate 35% instead of 20% shall be allowed if the following conditions are satisfied, like assessee sets up an undertaking for manufacture or production of any article or thing. Second condition, such undertaking should be set up on or after 1st April 2015. Next, such undertaking should be set up in the notified background area of Andhra Pradesh or Bihar or Telangana or West Bengal. Assessee acquires and install any new machinery or plant other than ships and aircraft. Moving further, consequences of changes in rate of exchange of currency defined under section 43A. Before understanding this, we have to understand the conditions, that under which conditions changes in rate of exchange of currency is applicable. First, assessee has acquired any asset in any previous year from a country outside India. Second, in consequence of a change in the rate of exchange during any previous year, there is an increase or reduction in liability of assessee at the time of acquisition of asset, at the time of making payment. Second condition, indirectly in any foreign currency, especially for the purpose of acquiring the asset along with interest. Moving further, taxation of foreign exchange fluctuation mentioned 43AA. Such gain or loss shall arise in respect of all foreign currency transactions, including those related to monetary items, transaction of foreign operations, forward exchange contracts, foreign currency, transaction reserves. The proceeds provision of Section 43AA is not applicable in respect of cases covered under Section 43A, like computation of actual cost of the asset, etc. Moving further, unabsorbed depreciation, Section 32, subsection 2. Depreciation which could not be fully deducted from profit and gains of current year of business or profession due to insufficient profit is termed as unabsorbed depreciation. Means, if the amount of depreciation is more than the income or profit of the business, in that case, the excess of the depreciation is transferred for the next assessment year. Moving further, a special deduction for assessee engaged in tea, coffee, or rubber growing and manufacturing business. As you see in the slides, it is mentioned all the assessee carrying on business of growing, manufacturing of the following in India, like tea, coffee, or rubber. For this, conditions to be satisfied are mentioned, and the amount of deduction is also mentioned. Conditions have to be fulfilled, then only these deductions are allowed. Minimum of the following is allowed as deduction: amount so deposited as discussed in the conditions, or 40% of profit of such business computed under head profit gains of business or profession before allowing any deduction under section 33AB and before adjusting brought forward business laws. So these are the ways to calculate a special deduction for the assessee who is in the business of tea, coffee, or rum. Moving further, deductions in respect of expenditure on a specified business, section 35 AD. This is applicable to specified assessee engaged in the business of setting up and operating a cold chain facility, setting up and operating a warehousing facility, laying and operating a cross-country natural gas or crude or petroleum oil pipeline network for distribution, storage facility being an integral part of such network. Moving further, continuing this, building and operating anywhere in India, hotel of 2-star or above category, building and operating anywhere in India, a hospital with at least 100 beds of partner for patients, developing and building a notified housing project under scheme for slum development, rehabilitation framed by central government or state government, developing and building notified housing project under scheme for affordable housing framed by central government or state government, production of fertilizer in India, setting up, operating an inland container depot approved under the Custom Act 1962, setting up and operating warehousing, laying and operating a slurry pipeline. So these were the deduction in respect of expenditure on a specified business. Now moving ahead, we are going to discuss payment to associations and institutions for carrying out rural development programs. Section 35 CCA. So what are the various payments which are to be treated as expenditures are mentioned in this slide. Where an assessee incurs any expenditure by way of payment of any sum, rural development and assessee furnishes a certificate from such association, the National Fund of Rural Development. Now moving ahead, discount on issue of zero coupon bonds, that is ZCB, section 36, subsection 1, clause 3rd. Means a bond issued by any infrastructure capital company or infrastructure capital fund or public sector company, scheduled bank, in respect of which no payment and benefit is received or receivable before maturity or redemption from the issuer, and which the central government may, by notification in official gazette, specify in this behalf. So in moving ahead, contribution towards RPF, that is Recognized Provident Fund, and Superannuation Fund. Any sum paid by the employer towards Recognized Provident Fund is to be treated as deduction in full. Such amount must have actually paid before due date of furnishing return. So basically we are discussing about various expenses incurred by a business and profession which are allowed as deduction in full while calculating the income from profit and gains of business or profession. Moving ahead, employees' contribution towards staff welfare scheme. Any sum received by employer from his employees as contribution towards provident fund, superannuation fund, other funds set up under Employee State Insurance Act, and any other fund for the welfare of such employee will be treated as deduction under section 36. Now, moving ahead, allowance in respect of dead or less animals. If business is having such type of animals for the purpose of business, then under section 36(1) clause 6 provides for deduction in respect of animals used for the purpose of business profession. Some conditions have to be fulfilled. Animals are used for the purpose of business. Such animals are not held as stock. Such animals have died or become permanently useless for such purpose. Quantum of deduction. Difference between actual cost of animals to the assessee and the amounts realized, if any, in respect of carcasses or sale of animal is allowed as deduction. Moving ahead, we will talk about now for about bad debts. So bad debts basically is the unrecovered amount for the businessman. So how we are going to treat bad debt is mentioned here. Any debt or part thereof which becomes bad shall be allowed as deduction. For better understanding, if it is the assessee who decides whether a debt has become bad or not, and the assessing officer can never insist the assessee for production of proof that debt had become bad. Assessing officer cannot ask for any proof regarding the bad debts. There are some conditions to be fulfilled to treat the amount as bad debt. Debt must be incidental to the business or profession of the assessee. There must be close nexus between the debt and the business of the assessee. For example, bad debt arising out of advances made by a lawyer to his client to assist him in purchasing properties is not admissible as bad debt, as it is not the business of lawyer to provide loans. Such loss is not allowed in provision of the Act. Second condition, the debt has been considered as income of the assessee of that previous year or of earlier previous year. Example, advance given to supplier for purchase of raw material later fortified is not allowed as deduction under this section. This is because the same has never been a part of income. Moving further, next condition is it must have been written off in the accounts of the assessee. One thing is to be keep in mind that provision for bad debt is not allowed as deduction. Exception to this rule is where the amount of such debt has been taken into account in computing the income of the assessee of the previous year, in which the amount of such debt becomes irrecoverable, or an earlier previous year on the basis of notified income computation and disclosure standards without recording the same in the accounts, then such debt shall be allowed in the previous year in which such debt becomes irrecoverable, and it shall be deemed that such debt has been written off as irrecoverable in the accounts. Next condition, business must be carried on during the previous year. Next condition, it must be of revenue in nature. Some points to be kept in mind for this treatment of bad debt. Bad debt is not allowed as deduction to the assessee who maintains accounts on cash basis. Bad debts are also allowed in the hands of successor of the business. Moving further, now what if the bad debts are recovered, then how these are going to be recorded and treated for the income tax purpose? It is defined in section 41 subsection 4, where a deduction has been allowed in respect of a bad debt or part of debt under section 36(1)(7) if the amount subsequently recovered on any such debt or part thereof is greater than the difference between the debt or part of debt and the amount so allowed, the excess shall be deemed to be profit and gains of business or profession. Mathematically, we can understand it as amount recovered less bad debt claimed or bad debt allowed as deduction will be treated as taxable bad debt recovery. Moving further, provision for bad debts. In case of following person, provision for bad debt shall be allowed to the extent of a specified amount. A scheduled bank or a non-scheduled bank or a cooperative bank other than primary agriculture credit society or a primary cooperative agriculture and Rural Development Bank, the rate will be 8.5% of the total income computed before making any deduction under this section. Additional deduction for the purpose covered under clause A or point A in this slide, 10% of the aggregate average advances made by the rural branches of such bank. Further deduction shall also be allowed, not exceeding the income derived from redemption of securities in accordance with the scheme. Next, foreign bank or public financial institutions, chargeable percentage is 5%. Moving further, deduction in respect of special reserve. Deduction is allowed in respect of any special reserve created and maintained by a specified entity in respect of reserve created from the specified business. The amount of deduction shall be list of the following: amount transferred to the reserve, 20% of the profit derived, twice the amount of the paid up share capital. So the least of the following three will be allowed as deduction in respect of a special reserve. Moving further, there are some general deductions mentioned under section 37. 1. Any expenditure which is not specifically provided in any provision of the Act fulfill the following conditions shall be allowed as deduction under this section. It must be real, not notional. It must be expected wholly or exclusively for the purpose of business. It must be incurred in the previous year. It must not be personal expenditure. It must not be capital expenditure. It must be lawful and not have been incurred for any other purpose. Next, disallowed expenditure. Following expenditures are expressly disallowed under section 40 subsection A. First, interest, royalty, fees for technical services payable to a non-resident or outside India is disallowed. For understanding it, where in respect of any such sum or amount tax has been deducted in any subsequent year or has been deducted during the previous year but paid after due date of submission of the return of income, such sum or amount shall be allowed as deduction in computing the income of the previous year in which such tax has been paid. Second point, any sum payable in resident on which TDS provision is applicable, 30% of any sum payable to a resident on which tax is deductible at source, such tax has not been deducted or not has not been paid on or before the due date of furnishing return of income. Next, consideration on which equalization levy is applicable, income tax, Indian or foreign. These are the expenditures are not allowed for the purpose of calculation. Moving ahead, wealth tax, royalty, any payment which is chargeable under head salaries, any payment to a provident fund, any tax on non-monetary perquisite, these are not allowable deductions. Now, we will discuss about payment made to relatives in excess of requirement. Any payment made by an assessee to a related person shall be disallowed to the extent it is excess or unreasonable as per the assessing officer. Here, related person means spouse, brother, sister, descendant, ascendant of the individual. List of related person in case of different assessees and their treatment. An individual for the purpose of assessee, an individual, a company, a firm, an association of person, an HUF. Related person means, and in case of individual, relative or a person whose business or profession the individual has substantial interest. Director of the in case of company, Related person means director of the company or any relative or the director, a person in whose business or profession the company or any of its director or relative of such director has substantial interest. In case of firm, partner of the firm or relative of a partner. In case of association of partner, a member of association or relative of the member, a person in whose business or profession the AOP or any other member relative of such member has substantial interest. In case of HUF, a member of family or relative, a person in whose business or profession the HUF or any of its member relative has substantial interest. So basically, relative person means person having any type of relation, having any type of substantial interest in the business of carrying by the individual, a company, a firm, a AOP, or any other. Moving further, maintenance of books of accounts, section 44A and rule 6F. Basically, what and how the maintenance of books of accounts is to be kept by the business and professionals is mentioned here. Various cases mentioned like case A, B, C, D, E, and F. Person falling under this category, turnover or income criteria, and maintenance of accounts. So, as per the turnover or income of criteria, existing person and new business is defined in this chart. So, taking case 1, case A, person carrying on specified professions, existing business amount 1,50,000 in all the 3 year immediately, and new business gross total receipts likely to exceed 1,50,000. Maintenance of accounts as prescribed by Rule 6. Case C, person carrying on non-specified profession or any business. Case D and E, an assessee covered under Section 44AE, 44BB, 44BBB, whereas provisions of Section 44AD, subsection 4 is applicable. So these are the cases on mentioning the limits of the amount of the person having the sales turnover or gross receipts or the profit on the basis of which income tax department has made compulsory to maintain the books of accounts. Moving further, what are the book of accounts to be maintained? Cash book, journal if mercantile system accounting is followed, ledger, carbon copies of machine numbered bills exceeding rupees 25 issued by the person, original bills wherever issued to the person or receipts where such bills and receipts are not issued and expenditure incurred does not exceed rupees 50, payment vouchers prepared and signed by the person. Assessee engaged in medical profession are required to maintain two more books. Daily case register in Form 3C. Inventory records of drugs, medicines, and other consumable accessories used in the profession. So these are the books of accounts have to be maintained by the person if he or she having the business and profession as mentioned in the above category in the previous slide, then these books of accounts have to be maintained by them. One thing should be clearly that books of accounts and other documents shall be kept and maintained for a period of 6 years from the end of relevant assessment year. There is also a penalty charge applicable if particular books of accounts is not maintained, that is amount rupees 25,000 as mentioned in section 44 AA. Now moving further, we are going to discuss about the term tax audit. An assessee carrying on business must fulfill the condition total sales turnover gross receipts of business for the previous year exceeds 1 crore, exception where a person declare profits and gains for previous year under section 44 AD. His total sales or turnover gross receipts in business does not exceed 2 crore in the previous year, then the provision of tax audit is not applicable. So basically, tax audit is the compulsion under section 44 AB if the conditions are fulfilled by the assessee. If an assessee carrying on business, we have discussed. Now, if assessee is a professional, conditions gross receipt of profession for previous year exceeds rupees 50 lakhs, then he then the profession has to be audited. If the assessee covered under section A E 44BB or 44BBB, then his income is lower than presumptive income. His income exceeds the maximum amount, and assessee covered under section 4D exceeds the maximum amount which is not chargeable to income tax in any previous year. If these conditions are fulfilled, then audit is mandatory. Moving further, if tax audit is not done by the business or profession as mentioned in this previous slide, then a penalty is chargeable as mentioned here if any assessee does not upload such audit report 1 month prior to due date of filing of return of income, then he is liable to pay a penalty being lower of the following: half percentage of turnover or gross receipt or rupees 1,50,000. Means the lower amount is to be paid as penalty. Moving further, special provision in case of income of public financial institutions, etc. Section 43D. Notwithstanding anything to the contrary to any other provision of the Act, following shall be applicable in case of, in nature of, and the tax treatment. So basically in this chart, special provisions are mentioned. A public financial institution, a scheduled bank, cooperative bank, society or a primary cooperative society, a deposit taking non-banking financial company, a systematically important non-deposit taking non-banking financial company, then the tax treatment will be chargeable to the tax in the previous year in which it is credited to the profit and loss account, or it is actually received whichever is earlier. Moving further, computation of business profit and presumptive basis. It is applicable to a resident individual, resident Hindu, undivided family, a resident partnership firm, and the conditions for fulfilling it is eligible business. Assessee must be engaged in any business other than business referred above. Maximum turnover, total turnover or gross receipt in the previous year of eligible business should not exceed 2 crore. Requisition on claiming deduction. The assessee has not claimed any deduction under these sections. Relevant assessment. Moving further, continuing it, estimated income, where amount of turnover or gross receipt is received by an account pay check or account pay bank draft or uses of ECS or through other prescribed electronic modes during previous year or before the due date of filing return of income, 6% of such turnover or receipt will be treated as the part of income. However, a taxpayer can voluntarily declare a higher income in his return. Moving further, business of flying, leasing or hiring goods carriage, section 44AE, applicable to all assessees. Conditions, number of carriages, more than 10 goods carriages during previous year. Owner of carriages include buyer under hire purchase or installment system. Goods carriage means any motor vehicle constructed or adopted for solely for the carriage of goods, or any motor vehicle not so constructed or adapted when used for carriage of goods. Estimated income from each good carriage shall be, if it is heavy goods carriage, presumptive income 1000 per ton for gross vehicle weight or unladen weight. For other goods carriages, 7500 presumptive income. Any assessee can declare higher income. Consequences of undisclosed income or investment. So we are going to discuss the what are the consequences of undisclosed income. Various sections are mentioned here. Section 68, cash credit. Section 69, unexplained investments. Section 69A, unexplained money. 69B, amount of investments not fully disclosed in books of accounts. Section 69C, unexplained expenditure. Section 69D, amount borrowed or repaid on Hyundai. Moving further, if any query, then you can ask. Hope you all have understood about the income and profit and gains of business and profession chapter for the income tax calculation purposes. Thanks and have a good day.